good morning or afternoon. I'm Daniel Bradley with TCIA, and it's a pleasure to welcome you to the discussion in partnership with our clients and Bannockburn Capital Markets. Our focus is navigating global trade, currency shifts, and credit risks, some of the things we already touched on just now. And these are front and center for all the businesses that we work with and most people in our economy right now, managing receivables, finance, interest rates. These are the hot topics you actually are seeing in the headlines these days. We're joined by Marc Chandler, Chief Market Strategist at Bannockburn, and Nick Omerly, Managing Director at Bannockburn, as well as myself and Tom O'Connell, brokers and partners at TCIA. Each bring a unique perspective on how to manage risk and find opportunities in today's markets. And so we'll start with some insights from Marc and Nick to get on the global economic and foreign exchange trends, and then Tom and I will be happy to share how this impacts our clients and the credit risk and insurance market directly as we go along. But thanks for joining us, and I'll kick it off to Marc to help provide some of the information he's put together for us today.
Great. Well, good morning. Thank you very much. Thanks for joining us. So I thought maybe I could begin really by just giving a broad framework, because so much things are going on. I think that we need some broad framework to really understand these individual events that take place. So I think that maybe the best framing of it is to think about the strategy of when you're a top dog country, when you've got when you're the economic preeminent power. There's a certain strategy that countries have adopted for several hundred years. And that strategy we can call free trade, or in the US, it's really called the open door, which was really based on open door of some notes were written around the early 1900s and sort of laid out how and why the US should be defending free trade. And think about at the time, early 1900s, what was happening was that the imperial powers in Europe and Japan were carving up China. And so these open door notes were really written to defend the territorial integrity of China. Instead of competing for a small piece of it, the idea was let's preserve its territorial integrity and compete for the whole thing. The US knew, or was confident, that the economic prowess would give us a greater market share than if we just got a little piece like the Bundesdistrict or Hong Kong. We wanted to compete for the whole piece rather than just a small sphere. And the US was really the revisionist power at the time, because the world was really carving itself up into these blocks. You had like the British bloc, its imperialism at its peak. Small island Britain was dominating huge parts of the world. France, Germany, Japan, all taking their pieces, their spheres of influence. And the US objected to it, though it could have just gotten its own sphere. But the open door was the main thrust of US foreign economic policy through the Great Wars and well into, you think about what happened after World War II, the institutions like the World Bank, the IMF, GATT, these were all, in effect, institutionalizing and globalizing the US emphasis on free trade. But what has happened more recently, and this is where sort of like leaving aside the history, what's coming up now is the US, I think, for the first time, recognizes that it's no longer the dominant economic power. And it is reverting back to a spheres of influence approach. I think this is what Greenland, Panama, Brazil, Argentina all have in common. And I should say Canada too, right? And it's very clear. One of the documents that's publicly available from the Trump administration is the National Security Strategy. And every president issues one, usually early on in their term, where they sort of outline their vision of the world. And it's very clear from the national security strategy, as well as these actions that we've seen over the last 10 months or so, the U.S. has adopted a sphere of influence. It's, in some ways, might want to think about it as like putting the Monroe Doctrine back into the fore. Back in around 2013 or so, the previous Secretary of State, John Kerry, had said that the Monroe Doctrine was dead. And instead, I think what we're seeing from the Trump administration is a revival. And not only are the US grabbing its sphere of influence, but one of the implications that it means is that the US will not spend much money or lives stopping another superpower, a great power, say Russia or China, from grabbing their own sphere of influence. And that I think partly helps explain the US ambivalent position towards Ukraine, right there on the Russian border. I think it also explains why the US has has changed its tone towards China and Taiwan, especially. And I think that we see this in after the recent meeting between the heads of China, Xi, and Trump, where Trump's social media post made reference to the G2. This is a very powerful statement, not just because President Trump said it, but because of it's really the Chinese who've been sort of encouraging that type of language. In effect, it's the US and China that dominate the world economy now. And so G2, in some ways, for the US to say it, recognizes the parity with China. And again, it stresses again the idea of focusing on the Western Hemisphere, our sphere of influence. And so I think that what this means is that we talk about when when China unveiled an AI last year, people talked about it as the Sputnik moment. Remember when the Russians beat the US in launching a satellite? And and so I think that we as in the US, Western Europe, have to become a more accustomed to more deep seek moments. That is, you think of just about the sheer scale of China. I mean, just the number of brain cells they can put to a problem, the number of engineers, for example, the number of software writers, just the sheer scale. And I think this is the source of a major misunderstanding about China. Oftentimes in the US press, we'll hear things like China is export dependent. And it matters how you look at it. But in terms of GDP, what does China export as a percentage of GDP? It's about 20%. Canada, who nobody really thinks is export driven, exports more than 30% of GDP. Germany exports more than 40% of GDP. The US, we're not a strong exporting country, and I'd like to explain partly why, but the US exports no more than 15% of GDP. And I think that to understand why the US exports relatively less than most other high income countries is to recognize the US strategy. After World War II, as US businesses really began expanding globally, the world was in like disrepair, right? It was ruined from the wars. Secondly, countries had to try to rebuild, they employed protectionism, different ways to protect their industries as they gained footing again. And also, by many measures, the dollar was overvalued. And so the strategy for that kind of condition, I'd say, is not export oriented because that runs into the winds of protectionism and an overvalued dollar. Instead, the US pursued what we call a foreign direct investment strategy. And this is really the source of the supply chains that are often so much in the news these days. What happens is rather than servicing foreign demand by exporting from the US companies built production and distribution facilities all around the world. So what happens is since the early 1960s, which is the earliest the US data collection began, the subsidiaries of US multinationals overseas, they sell more goods than the US exports. It's not even close. It's by something like a factor of 4 or 5 to 1. These local sales. Well, how do these local sales get their products to sell? Partly, these are the supply chains, right? They manufacture parts, they import maybe from the US, import semi-finished goods, export the finished good or produce the finished good and then sell it locally. So the US strategy has been a direct investment strategy, and that's why we can get these complicated, complex supply chains that are so much in the news. So, so China, though, the sheer scale of China, for example, they export less than 25% of the autos that they produce, but they produce so many autos that the sheer size of it overwhelms many countries, even though they're not technically exporting more than other countries. It's just that the economy is so much larger. And that's really, I think, the key essence here. So when we think about areas in which we should expect China to have what we call the escalation dominance among supply chains, we've seen some, back in 2010, China was punishing Japan by denying them rare earth magnets over a dispute about some islands. That should have been a wake-up call to the United States, but here we are, 15 years later, and we've hardly made any progress in freeing ourselves from from China's chokehold on rare earth magnets. And remember, with the rare earth, it's not just the rare earths themselves. We have plenty of those, really. The real shortage is in the processing. And even though other countries might have some processing, China accounts for 90% of the rare earth processing, turning them to magnets. But there's other areas that we should be aware of that China also is going to begin exerting, I should say, like having supply chain dominance. Pharmaceuticals, many of the precursors for antibiotics in the United States come from China. You think about EV batteries, and EV batteries aren't just for autos, even for drones. You need those EV batteries and you need the magnets in drones. Another element of China's supply dominance. Solar panels, the the legacy semiconductor chips, not necessarily the cutting edge ones, but the ones that are in so many of our products. Cell phones. You can think about any household product, any consumer electronic. That China is really beginning to dominate those legacy chips. So I think that to understand what's going on then is to recognize that we're in a moment in time where the US has been the top dog country since before World War II. And now, on the margins at least, and increasingly, not just on the margins, but increasingly like on the bone itself, China is becoming more dominant. And the US has had to change its overall strategy, its geopolitical strategy. And just like I say that President Biden continued and extended the tariffs against China we saw in Trump's first term, we should expect as we fast forward, think about what the future is going to be, the post-Trump future in the United States. I don't think that we can go back to status quo ante. Sort of like squeezing the toothpaste out of the tube. Once it's out, it's next to impossible to put it back in. And it's within this context of the great power rivalry, the change of the U.S. course for the spheres of influence, that now I can drill down a little bit and talk about two other themes, two other important topics that concern us. One is interest rate policy, Federal Reserve. And to appreciate what's going on, I think you have to realize that the dollar has uh, has been in an uptrend since basically the early days of COVID, which is one of the things I like about the foreign exchange market. Trends can last 5 to 10 years sometimes. And I think that we're finishing up a dollar super uptrend, lasted over 10 years. And today, and what makes it hard for US exporters, leaving aside this direct investment strategy I painted for you, but what makes it hard for US exporters is that the dollar is terribly overvalued. Now, I know that when it comes to buying a company or trying to price a bond, there's certain agreed upon valuation methods. Even though we might disagree on which one's appropriate, there's a finite number of agreed upon models. But in foreign exchange, my crypto friends are right. They're not backed by gold or silver anymore. So valuation in currency is much more elusive. Think about those mixed martial arts fighters or boxers. Sometimes they say a small guy is stronger pound for pound than a big guy. Right? Maybe the small guy can bench press his weight, but the big guy can only bench press half his weight. even if it's more pounds per se. We say that a small guy, pound for pound, and I think we try to do the same thing, try to come up with valuation in the foreign exchange market. But rather than pound for pound, we call it purchasing power parity. And you're probably familiar with its a simple but popular example in The Economist magazine. Every year they look at the price of a Big Mac, say that's a tradable basket of goods, and it should trade for the same price, regardless of what country, once you make the currency conversion. But to the extent that the Big Mac is different in price after you make the currency conversion, shows some currency is out of whack, out of line with its fundamentals. The Organization of Economic Cooperation and Development has devised their own model of purchasing power parity. And this is for let's say 25 of the largest economies in the world. And what they find is that typically currencies, while they move around valuation quite a bit, they tend not to be more than 20, 25% on either side of fair value. But as we sit here today, the yen, Japanese yen, is almost 60% undervalued. The euro is more than 50% undervalued. And Canadian dollar, the third most undervalued currency, is about 25% undervalued against the US dollar. There's only one currency that's overvalued by the OECD's measure, purchasing power parity. That's the Swiss franc. And what's interesting about the Swiss is their overnight interest rate, comparable to our Fed funds rate, is zero. And the market is betting that the Swiss National Bank, as early as next month, could adopt once again negative interest rates. Right now, Swiss's 2-year yield is minus 20 basis points. Imagine that. In order to protect your money, you say, well, I'll give it to the Swiss National Bank. They seem to be prudent managers. They charge you 20 basis points. It's really mind-boggling to me, negative interest rates. The closest I can come to trying to get my head around it is when I go to an ATM that's not my bank's. I take out $100. Sometimes the ATM charges me a fee of $2 or $3. $2 or $3, 2 or 3% just to get access to my money. It's almost like a negative interest rate. During the COVID and the great financial crisis, countries in Europe, even Italy, Spain, were offering negative interest rates. You'd say, well, maybe it's one thing for Germany or Switzerland. It's another thing for the periphery of Europe to do so. And that's sort of the look through the looking glass, through Alice in Wonderland's looking glass, the kind of world that we live in, I think, is where negative interest rates, sort of my career was based partly on the belief that you could get negative interest rate, that zero was the bottom. And here we are in a world in which we still have negative interest rates. And I just give Swiss as an example. But the idea, I think, is that we're involved in a monetary cycle, that during COVID, of course, all the central banks were cutting interest rates. And when you get close to zero, if you're like the United States or the UK, you don't want to adopt negative interest rates. Central banks pursue what they call quantitative easing. And that's where they're buying large amounts of bonds. They say when you're at a zero bound, to still ease monetary policy. So during COVID, we had, of course, all this incredible easing monetary policy, fiscal policy. Since COVID, central banks have tightened policy, and now that business cycle has come to an end. And the Federal Reserve, as you know, last week cut interest rates, and it was the second cut of this year, and I'd say that the market right now, so you could think about it, the market's pricing in 3 to 4 more cuts by the end of next year. And how can you find what the markets are pricing in? Because ultimately that's what counts. It's not what any one economist might think, but what the market is discounting. And the way you can do this from home is where they trade Fed funds futures at the Chicago Mercantile Exchange. And so in your search bar, if you go a CME Fed Watch, you'd find that where they trade these contracts, they'll tell you what the market's implying for the Federal Reserve policy. I just have the tools to do this, not just for the Federal Reserve, but for other central banks. And what's happened is even though the Federal Reserve cut rates 3 times last year, they were on hold this year until September. While the Fed was on hold, other central banks went ahead and cut interest rates. And so we're at a point in time where the Federal Reserve has begun cutting rates again, just as other central banks are done, like the Bank of Canada says that they're done, or other central banks have maybe one cut or two cuts left in the cycle, like perhaps Reserve Bank of Australia. The market thinks that the ECB, the European Central Bank, is done tightening policy, excuse me, done cutting interest rates, and the UK may cut interest rates once next year. As I said, the Federal Reserve, the market is pricing in 3 to 4 more rate cuts by the Federal Reserve. So as the Federal Reserve cuts interest rates, an important support for the dollar is weakened. Right now, because of the interest rate differential, one is paid to be long US dollars. That premium to be long, that payment that you paid, that premium to be long US dollars is going to be reduced as the Fed cuts interest rates. And my thinking is that's going to weaken the dollar. I think that the challenge, of course, is I'm sure you've seen many people are talking about the US falling into recession and expected the Federal Reserve to be easing rates more aggressively. But what's happened this year is really is quite remarkable. Partly the tariffs, the anticipation of the tariffs, are trying to front run them, may have weighed on growth in Q1, boosted growth in Q2. In the first half this year, the US economy grew by about 1.6%, which most other high income countries wish they could have that kind of growth for a whole year, let alone just the first half. But why were people like myself wrong about the economy? And I think it's because we underestimated AI. When you look at the AI construction and the larger infrastructure around AI, estimates vary, but it could account for almost half of US growth in the first half this year, maybe even a little bit more. So the strong AI has been lifting the economy on the aggregate, but there still are big pockets of weakness. And some think that leaving aside AI, high tech, manufacturing, we're losing jobs. It's contracting. Construction outside of AI is weak. Consumption, you see this in households. Debt stress levels are high. This is how much disposable income people have to service their debt. It's the delinquency rates on credit cards. It's the default rates on even on used cars. And so the economy still seems fragile. And this is why the Federal Reserve is seen likely to be cutting interest rates again. Now, the next meeting is in December, and it's not clear whether the Federal Reserve will cut. The market has right now, whether you look at the Fed funds futures, or you look at the event markets like Poly Market, they have about 2/3 of a chance that the Federal Reserve will cut rates in December. I'm not as convinced, and partly I'm not as convinced because inflation in the US has risen, headline inflation, headline CPI has risen for the past 5 months. Remember at the end of last year, President Trump, after the election, was very critical of Biden and saying inflation was the worst it's been in American history, which of course was a typical exaggeration. It was about 3%. Now President Trump says there's no inflation, and headline CPI still about 3%. But the Federal Reserve, as you know, has two mandates. They want to keep stable prices, but they also want to have low unemployment. And the reason the Federal Reserve is cutting interest rates is because it seems like the labor market is deteriorating. And it's hard to tell these days with the government shutdown, but there's a lot of other data, private sector data like ADP, which does a lot of companies' payrolls in the United States, and they provide an estimate of private sector jobs growth. There's a lot of other small, private companies that also surveys that have estimates about the U.S. labor market. like the Purchasing Managers Index, which is among the first data points in a month. ISM, the Institute for Supply Management, they also have labor market estimates. Federal Reserve, different regional feds have different metrics, different models to try to forecast job growth. So there's a lot of places to look for it, but the bottom line, maybe I'll save you some time, the bottom line here is that they're all deteriorating. It's really how fast they're deteriorating. It becomes a key question. And the Federal Reserve thinks that if the labor market deteriorates, so goes the economy because the labor market is the key to consumption. And consumption is still a big chunk of the driver of the US economy. So you have then this picture of the world fragmenting. I think that we should count on breaking into several different blocks. Of course, you have a Chinese block, you have a North American block. I think you'll have a Eurozone block. And multinational companies then will have to operate in those three blocks. That's part of their advantage. Points of production, distribution, sort of the regulations, how to produce things, sizes, those kind of like industry standards, but also vary from block to block. That's going to be very expensive for small and medium-sized businesses. Large multinationals can, of course, be located in all three blocks. Smaller, medium-sized businesses have to stay within their block. So rather than finding inputs or suppliers or customers in Asia or Europe, US small and medium-sized businesses might be better served trying to find that customers or inputs within the Western Hemisphere. And it's complicated. It slows things down a little bit, and I think it's less disruptive than the alternative of trying to operate in three different spheres. Exporting from the US, if I'm right about the dollar will get cheaper, though it takes a while. These trends move very slowly. It took years for the dollar to get so overvalued. It's going to take years for the dollar to become more fairly valued. I think that process has begun. And maybe that's the other thing to say, just to wrap this up, is about the outlook for world trade. The world, the GATT, the General Agreement to Talk and Talk, broke down in the early 80s and has been replaced by the World Trade Organization. And they provide estimates on world trade. And back in August, they thought that world trade this year was going to grow by less than 1%. Because of the tariffs and what they expected to be retaliatory tariffs, almost like a repeat of the Smoot-Hawley that I'm sure you've seen those downward spirals in world trade after the Smoot-Hawley tariffs and the retaliatory tariffs, and just a vicious cycle. But what the World Trade Organization said last month was that they were revising up world trade for this year from 0.9% to 2.4%. And they made that decision after 2 months of time, right, between August and October. And part of the reason they said was that they recognize now about the front loading of imports from the US, imports into the US to avoid the tariffs, which helps explain for some of those distortions we saw earlier this year on trade as well as inventories. They said there was also a surge of AI-related goods. So some of that AI contribution to GDP was offset on the margins by greater imports for some of this capital equipment we needed. And thirdly, unlike what happened in Smoot-Hawley, we're not seeing massive, widespread retaliatory tariffs. Canada and China are probably the biggest retaliatory tariff sources. Europe a little bit, but I think most countries have like willing to absorb it, partly because they don't think it's going to last that long. That is to say, they think that after 2028, the U.S. will come back to its senses and not treat its allies like enemies. You know, with the latest announcement from the past weekend about Trump and Xi tariff and the cut in the fentanyl tariffs, the U.S. has a higher tariff today on Brazil and India than it does on China. And many people, I think we're going to see Congress already objecting to the tariffs on Brazil. They haven't quite been able to get their act together with the government closed and the high divergence. But I think that what we're going to see is the tariff news. And again, you don't want to only focus on the headline tariffs, what really the effective tariff is, because there's so many exemptions and so many carve outs. But I think that we're going to see the tariffs move off the headlines by the end of Q1 next year. And the reason is that the US will turn its attention to the midterm elections, and the tariffs are terribly unpopular in the United States because people, households, experience it as inflationary. Many Federal Reserve officials think that out of that 3% inflation or so that we're experiencing, about 0.7 can be traced to the tariffs, which puts inflation, excluding the tariffs, something closer to the Federal Reserve's target, 2%. So we've got this sort of this big chain then of the U.S. Abandoning the open door and free trade, adopting the spheres of influence, the fragmentation of the world economy, trade holding up better this year, but will pay for it next year. The World Trade Organization says next year they cut the trade forecast, trade growth from 2.5% to 0.5. So this is so that they basically what they put from what they expected next year into this year. And I think that one thing that will help U.S. exporters is that the dollar is going to decline further as the Federal Reserve cuts interest rates faster than other countries. So thank you for your time, but let me turn this over to Nick, and then maybe we could open up to some Q&A.
That'd be great.
Thanks, Mark. And I'll just welcome everybody. Mark and I are colleagues with Bannockburn, as Daniel pointed out. And why don't we just open the floor to questions? I'd like to lead with a question, if that's okay, Mark.
Sure.
Surprise, surprise, right? I'm first of all, I'm wondering, with this last meeting with Xi, do you have any information that maybe we're not seeing that's non-obvious about what did they walk away? Where did we walk away from with regards to rare earth and the processing of rare earth? Is that in there? And I know that fentanyl there's some agreement there, but what did you glean from that meeting on the rare earth?
Yeah, I think that it's a good question, because I think that this was this is of course where the U.S. has been focusing on with the rare earths, because already we saw when China had threatened to cut them off previously, we saw a big disruption in the automotive sector, vehicle production. Yeah, there's like hundreds of these little magnets in automobiles. You think about things from moving car seats to windshield wipers. They're very extensive, even though we don't often see them or think about them. So I think that the big thing, I think the big agreement was that China will give the U.S. another year, not just the U.S., but really the world, another year where it relaxes its export restrictions. It's not clear whether the magnets, these rare earth magnets, will go to military use, but they will go to industry. And we're already seeing some signs that they've loosened up a little bit, even in the past week, with more. So it's not getting rid of the licenses that China insists on, but it's making them more available, making it easier to access those licenses. I think that it doesn't solve the problem. It buys us another year. And it depends on how you think about things. I mean, I am very proud of the U.S. Technological prowess. And I think that it might not take 5 to 10 years, as many people had thought, to
Right.
get to that processing, but it's still going to take more than the 1 year grace period.
Right.
And when President Trump and Treasury Secretary Bessent were asked about it, both suggested that after early next November, as we turn our attention to the midterm elections, they will likely, they think that as the U.S. thinks, that can extend it for another year. So we can buy some time, but like sort of 1 year at a time. I'm not so sure. I think that there's many people like myself who think that this trade truce is a very fragile. Already, you saw what happened over the weekend, for example. President Trump threatened to attack Nigeria, who is a very large beneficiary of Russia and Chinese funds and resources. Today, China said no, that they're gonna stand with Nigeria. And so I think there's still a lot of flashpoints, potential flashpoints between the U.S. and China. And I would not be surprised to see China play, if not their rare earth card, they have other cards to play, including, as I mentioned, like pharmaceuticals, EV batteries, and their technology. We often protect our patents jealously. We think China steals intellectual property. China now has created their own like a patent portfolio, if you will, for a lot of their EVs technology. And so it's not so clear how it's going to play out, but I think that China has other points where they can dominate the supply chain escalation ladder. And so I'd say that we have a sort of a uneasy truce between the U.S. and China right now, but specifically, it looks like auto companies in the U.S. and Europe will begin getting those rare earth magnets again, and probably not have uh, to stop the assembly lines.
Thanks, Mark.
So for anyone listening in, there's a Q&A section at the bottom. I think I got one. Let's have this question from Paul. What do you think will happen if the Supreme Court rules against Trump's tariffs, and what is Trump likely to do then? I like that you mentioned Polymarket because I saw that there is a pretty much the same two-thirds odds that they as of like recently, the odds are that they will rule against Trump's tariffs. So what do you think would happen in that situation?
Sure, yeah, and I think this is the Supreme Court here is the oral arguments tomorrow, and it looks like many people are anticipating a decision sometime either late this year or early next year. There's been a lot of briefs filed in trying to encourage the Supreme Court to deny President Trump the authority under this Emergency Powers Act to impose these tariffs. But this would not be really new news for the Trump administration. They see the same things that we're seeing. That even though the president has a majority appointments on the Supreme Court, a majority of conservatives, that it's not clear that he's going to win this case. And so I think that they're preparing the backup, and the backup is there's only, I'd say, about 60% of the tariffs come under this Emergency Powers Act. The rest come under other actions, other authority that the president has. And so the first thing I think is that they would try to shift some of that authority over to these other acts. So take it away from the emergency powers. The challenge with that is they tend to be more limited without congressional approval. So they need congressional approval just at that moment in time where Congress doesn't seem like it can approve anything, including when to be in session, let alone the budget. And but it does mean that the executive power, and this is, I think, part of the constitutional challenge, is this concept of unitary executive. How much power does the president have? And this is a different system than the parliamentary system, say, that Europe has or Japan has. And so in the US, we have this idea of checks and balances. President Trump is trying to like really explore the limits of that executive power. And so I would think a couple of things to say about these tariffs is that U.S. businesses have paid about $85 billion in tariffs. But you know how Wall Street works. These are potential revenues for companies. They might get refunds. But if any of you've seen the play, the musical Hamilton, it's very similar situations happening now. And Hamilton, remember what happens? The poor farmers who the Revolutionary Army ate their livestock, ate their grains, stayed in their houses. They were paid in these continentals, the money of the new fledgling republic. Many people did not think that that republic would survive fighting the greatest empire at the time. And so those farmers sold those continentals at a discount to Hamilton's friends. Well, that's exactly what U.S. companies are doing now. Many U.S. companies are selling the possibility of a refund to hedge funds for roughly 30 cents to 40 cents on the dollar. So some businesses haven't done that. They'll get the refund. What will they do with the refund? They'll probably either use it for capital investment or put it aside for the new tariffs that are going to be coming under separate authority. The hedge funds who are buying these refunds at 30 to 40 cents on the dollar, it's just another potentially a profitable trade for them if the Supreme Court overrules the president's action. But I think the important thing is that there's to take away from this really is that while the Supreme Court may overrule the president on these emergency tariffs, it might allow some tariffs, like the tariffs on fentanyl, for example. And I should say on the fentanyl trade violations. Uh, so there's other authorities that the president has, but they are more limited in scope, limited in nature, and require Congress to have a greater say in this. So I won't think that there's going to be it'd be a short-run disruption. The administration will find new authority, but I don't think the administration is going to give up what President Trump has said is one of our key powers right now is tariffs.
Makes sense. Yeah, that's a good, appreciate that answer. We have a couple minutes left and just maybe wanted to see in summing this up, practically nuts and bolts strategy, what would you recommend if I'm someone in the context of global trade increasing and the dollar likely decreasing in power? In the context of all that over the next 3 to 6 months, what are some strategies that you would recommend for a small to medium-sized business in the US experiencing that?
Yeah, I think one of the important things that's happened is when the dollar is appreciating, people who are buying goods from overseas are happy to take an appreciating dollar because we pay them at a dollar, and by the time they can use it for their own current, time they convert it and everything, it might likely appreciate in value. So when the dollar's in an uptrend, our counterparties of the trade are willing to take dollars. That's no longer the case. Even though I say the dollar has been steady to rising in the last couple of months, the dollar is still weaker, and the outlook, my bearish outlook, is really sad to say, but it's part of consensus. And so what that means then is that many of your counterparties, especially for small and medium-sized businesses, don't want to take the dollar anymore. We've seen this among our clients, that many of them have indicated that that the businesses that they're buying the goods from overseas want to be paid in local currency. Because again, the dollar is perceived to be a wasting or depreciating asset. So it costs them so if we pay them dollars, they think it costs them. So I think that the prudent thing, I think, in general, is hedging. And hedging, so that is to say that whether it's interest rates, commodities, currencies, there's some risk that businesses face that can be hedged. There's some risks that can't be hedged. There's things that we already know can be hedged, fire, flood, disasters. There's insurance products, and I think what businesses do is they see some of these financial risks, like currency risk, as a risk that can be hedged, managed, and there's insurance-like products out there. And the important thing too, I think, about this is when I first got involved in the foreign exchange market, businesses who wanted to transact, they really needed $1 million, which is a lot of money for small and medium-sized businesses in one transaction. But in the last 30 years or so, there's been a democratization, if you will, of the capital markets. So some of these insurance products that were only available to large money multinationals, large asset managers, sovereign wealth funds, these large pools of capital now are available to small and medium-sized businesses. And it's not just going to this, going to a store and buying a suit off the rack. These insurance products, say a simple thing like a forward in the foreign exchange market, which is just you're buying a machine tool from Germany. And you're not going to get delivery for 3 months, but you could lock in the price today by one of these forward contracts, really insures you against an adverse price move. These are available for small and medium-sized businesses in a way they weren't many years ago. And so I think that recognizing that there's some risks we can manage, and those risks that help us sleep at night by managing those risks, I think it's a prudent thing to do. Even though it's a rainy season where I live, I still have fire insurance on my house. And even during the driest part of the summer, I still have flood insurance. It just seems to be the prudent thing to do. For businesses, I think there's some risks we can't manage. Sort of the uncertainty coming from the White House, how long Congress is going to be closed for. Those we can't really manage those risks. Currency movement, interest rate movement, commodity prices, we can manage those risks. So I think it's just prudent to try to manage the risks we can and recognize that there's no such thing anymore as too small. If something that is important enough that it keeps you up at night, or you have to have a meeting about, or you worry about, that tells me it's a sufficient size to manage it, and which is to hedge it, which is, like I say, hedging is just another way of, in the foreign exchange market, in the capital markets, we talk about insurance.
That's great. I appreciate your time. I mean, we've reached the end of the scheduled meeting, but I appreciate everyone that's listened in. And if you listen to the recording, you're a client of ours and someone that we felt would be, benefit from this conversation. So feel free to let me know if you have any questions that come up in the coming days and weeks, and we will help make sure that those get addressed by Nick and Mark. We'll keep the conversation ongoing because things will continue to change, in the days and weeks and months ahead of us. So maybe come January, we'll have a resolution to the Supreme Court decision on Trump's tariffs, and that will stir the pot all over again. We can revisit this conversation again after the holidays. But I appreciate both of you being here, and appreciate everyone that was able to listen in. And so, I'll send a recording of this out to everyone that registered and follow up there. So, any other thoughts or questions before we close this out from Nick and Mark and Tom?
Thank you, Daniel, and Tom. It's great working with you guys. And Mark, as always, thank you. We're very lucky to have Mark as a resource and as a partner at Bannockburn, with his insight and his perspectives. So please, let's keep the dialogue. Like you said, Daniel, let's keep the dialogue open. Uncertain times require some level of certainty. And I think Mark summed it up perfectly when he said, if it keeps you up and if it makes you have a meeting, then it's probably worth considering. And something else around dollarization, of how markets have been dollarized while the dollar is strong. It's always good to have transparency around how you're trading. And my recommendation, this isn't necessarily a strategy, but just a best practice, is to, if at all possible, if the currency is tradable or if the commodity is tradable, work in it and hedge it if necessary, and don't fall back on dollarizing everything, because there's no transparency in that. Transfer costs are part of that price always, and you can see them and understand them and react to them better when you're working in the currency of either your vendor or your customer.
Yeah, very helpful. Thank you, Nick. Any other thoughts or questions that come up, I'll make sure to relay this through, and appreciate everyone for joining today.